Guys, today we are talking about big mistakes or big risk that I often see dividend investors make. Um, these mistakes are kind of going to act as an obstacle or roadblock to us in our journey. And, I'm sharing these mistakes, from a position of I've probably made these mistakes before or something similar. So, I've been doing this for 6 years now. I'm 22 years old. Um, and I've definitely made, you know, many, many of the common mistakes in the book. Anytime I can, make you guys aware of things to look out for on your journey, I want to do that. So, we're going to get into it, but real fast, guys. It's a great day. I saw this comment this morning. It was pretty special to me. So we'll look at it real fast. He said, nice video. Started my dividend journey a year ago. 2023 was not good for me in terms of having money to invest. He said he had a struggle with cancer, and then obviously there's a lot of medical bills that come with that. So, we'll keep him in our thoughts and or prayers if you're religious. But he said 2024 is starting off good. So that's awesome. And then later he goes on to say, I like that your videos are more personal compared to lots of videos where it kind of just goes through the math. It goes through the compounding. He said he's almost 50 and he's really focused on kind of his 5 year from now mark. Guys, this made my day because it's like, he had a rough 2023, but 2024 starting off good. And then he went ahead and gave me a great compliment. I try to make my videos very personal and real. I show my portfolios. I show my buys. I talk about where I'm at, mistakes I've made. And thank you for saying this, guys. I also understand, this guy's almost 50. I'm 22. So this dividend investing community that we're trying to build here, there's going to be people in all different walks of life, all ages. But, I'm trying to build a supportive community where we're open to sharing, our portfolios, our picks, our opinions, guys. I may not have the most subscribers, but I definitely have the best subscribers. Okay. That was a bit of a tangent, but that was a great comment. Thank you, Stormer. Okay. Now we can get into this video for real. First off, guys, the first biggest risk or mistake I see dividend investors make, guys, is misaligned goals. And we just mentioned how dividend investing comes in all, walks of life. However, with that comes nuances. Okay. If you're younger, let's say you're in your 20s or early 30s, really whatever age you're at, and you're not as focused on using your dividend income to pay bills, to pay living expenses, ideally you're trying to reinvest as much of your dividend income as you can. For me personally, that's kind of my situation right now. It doesn't make sense then to focus on, funds or stocks that have more of a kind of a current income producing, goal. Okay. So we've talked about some covered call ETFs on this channel, guys. If you're younger and you're using a covered call ETF such as QYLD, it's going to be discouraging because, as you see kind of the share price in that one fall, you're going to realize it's not the best for compounding. Okay. So maybe if you're a little older and you're focusing on paying bills with your dividend income, then, it's kind of a different story. However, if you're younger, you have to say, I'm kind of in the accumulation phase of this game. So I probably want to focus on something that has a more dividend growth prospects, more free cash flow growth prospects, stuff like that, guys. Not to mention the tax aspect of things. If you're focused so much on current income and you're racking up a big tax bill, that is obviously going to cut into your compounding. So, let's not go overboard on this point, guys. I hope I made that as clear as I could. But if you're focused on high current dividend income, that's most likely going to be at a point where, you are using those dividends to kind of pay bills, guys. That's the first risk I wanted to go over. Let's move on. Number two, this one is so popular, over diversification. And obviously, you guys watch YouTube videos about investing, and I don't know if over diversification is stemming from that. However, if you're putting money in all these different stocks, what that's going to do, it's not going to allow you to kind of build out positions in your higher conviction plays. It's not going to allow you to focus on valuation, focus on that starting yield you're locking in. Rather you're just kind of sprinkling money, across many positions, guys. It's not going to work well in the end because, you really can't. It kind of goes back to the point of like, you can't be an expert in everything. You really need to focus on your conviction in one position at a time, build it out to a sizable, position in your portfolio. And, when you see that share price appreciation or you have the position built out, that's when you're going to move on. Okay, now what's more attractive? Does that make sense? If you're buying, depending on your portfolio size, if you're buying 20 or 30, 40 stocks at a time, guys, yes, you are going to have all those small dividend payments coming in. But at that point, you're never really going to get to that outperformance because you're not focusing on getting the highest quality positions at the best valuations. And that's one of the things we try to focus on this channel. Just in the habit of showing my own personal examples. I don't know which one you guys want to see for reference. We'll go with Pfizer because I am down on that one. Actually, we'll go with Realty Income because it's quite a bit bigger in my portfolio. Okay, so we'll peek at my position here on this one, guys. So, I started getting in this one, when it was in the mid 60 mark. I got in it in late 2022, guys. And, from there, I had built out a position kind of with this lump sum. However, we see the share price of Realty Income. We see it fall. This could have been because of the high interest rate environment. We could talk about the why. However, what am I doing? Okay, while this one falls, I'm picking up more shares when I can. I'm averaging down because I have that conviction built in this one. Okay, I understand I got in at not the perfect cost basis, but I have the conviction in this one. I want it in my portfolio, and I continue building it. I'm building into this position while it's down. Whereas, if I had 20, 30 stocks I wanted, maybe I get in this one at not the best time and then it falls. Now I'm looking at another one. I can't really ever create kind of these solid starting yields, solid cost basis, yield on cost type plays. Okay. Does that make sense? So I hope that example kind of helped with the point. I'd go through another, but I have whole videos focused on that. This video is not so much focused on my own portfolio. It's more just, this dividend investing game as a whole. And then this last one, I put math is math, but old habits die hard. So over winter break, I was able to read this book called The Income Factory. It's a pretty good book for dividend investors. I think it drives home a lot of really good points about, total return, where that can come from, share price appreciation, and dividend yield. And this quote stuck out to me: math is math, but old habits die hard. And I included that because I wanted to kind of embody the risk of, okay, before you became a dividend investor or whatever, you probably had some bad habits with trading, trying to pick times when the market's up or down. Guys, that's real. That over management of money is really going to work against you in this game of dividend investing, guys. Just like we went over with the previous example, if a stock is down, that is not a time to panic. That is not a time to try to sell out and then wait for it to start to recover. That is going to really work against you. That's a bad habit. Maybe it's an old habit, and you've got to get over that. So, one of the great things about being a dividend investor, guys, is the longer you're in this game, the more kind of immunity you feel to share price swings or changes in the broader market, because you realize this game is about finding opportunistic positions and entering into them. It's kind of a game of finding opportunity. So if stocks are down and you're interested in them, you have a great opportunity to buy. If you're in a stock and it's up, okay, all you're doing there is enjoying your dividends from that position, using those dividends to reinvest into, other more opportune companies. So this last risk is going to be just over management of money, taking bad habits from the past, guys. I will show an example here because I think it's good if I show. It's one thing for me to say, oh, don't make this mistake, but I feel like it's probably going to hit closer to home if I show a time when I've actually made this mistake. So that's on SoFi. This is not a dividend stock, but it is not really in my area of expertise. But for whatever reason, me and some buddies, we all decided at one point we were going to go long in SoFi stock. We did a bunch of corny research on it, whatever. And I don't know. Nowadays, I don't keep up with kind of the underlying business of SoFi, but I threw $4,000 or $5,000 into this one basically for no reason, guys. I was doing dividend investing during this time. I knew where my capital should have gone, but I had a bad habit, kind of a bad habit of trying to trade into these more speculative plays. I made the mistake there. Fortunately, I was able to take it off for, I don't know, a small loss. But, the mistake was there, and that was time. I could have been looking for opportunities in kind of the dividend stock universe, and I also could have been collecting dividends from that capital, guys. So with all that being said, I hope you enjoyed today's video. I'm Cashflow Cart. This is my dog. This is my dog, Mia. She sits on my lap sometimes. But everyone have a great rest of your day. Hopefully you took something from this. And if you did, feel free to subscribe. Thank you, guys. And I will catch you in the next one.